Everybody's taking credit for inflation coming down. I would have thought that maybe Jay Powell could claim more credit than maybe the Biden administration. You don't want to give credit even to the Fed for why. Why do you think inflation came down necessarily?
Well, I would say that instead of self-congratulations, we should be taking this opportunity to really reflect on the lessons learned from this very odd period since March 2020, after COVID hit. And I think that we could say, well, if the Fed is responsible for inflation coming down, that must mean that the way you fight inflation is to increase the cost of capital. And that could be the wrong lesson, because that would tell us that if inflation were to start heading back the other way, maybe because of energy prices going up or housing prices, then the Fed's recipe would say, oh, we have to go back to doing it. Let's keep driving up the cost of capital. Let's keep raising interest rates. An alternative explanation could be that the inflation was caused primarily by the historic level of fiscal transfers during COVID. And that money is now running out. And so we see a decline in that excess demand. Then I think the lesson we should draw is when you pay people not to work, you're going to get excess purchasing power. That money goes straight into their bank accounts, straight into their pockets, and finds its way into the CPI because they spend it on goods and services. So I think we should be aware of that impact, that it was fiscal. And if that's the case, then the Fed's model, which says that you should have high interest rates so that some firms can't survive, people get fired. If that was the Fed's model, it didn't work out the way they anticipated. We have high growth, which is great. We have low unemployment. And I've always said that low unemployment and high growth, those are not inflationary. What you want that to be is productive economic activity. What I wouldn't want is for the lesson from all of this to be that somehow government stimulus, whether monetary or fiscal, somehow is a good thing. I think there are very debilitating economic consequences, one of which is that the Fed is now paying 5.4% to banks to keep the money sitting dormant at the Fed, doing nothing. I think the overall effect of all the government stimulus, even as we try to normalize, which would be the best thing, is we are slowly shifting power away from the private sector toward the government. A lot of that GDP growth was hiring government workers and engaging in government-financed projects. That means through deficit financing. That works its way into both employment and GDP numbers. But is that healthy? I still believe that the ideal system is to let individuals in the private sector pursue life, liberty, and happiness under conditions of a stable dollar and accurate price signals. So I don't want any of this to empower the Fed or the Fed to get too self-satisfied when it may turn out their model is not the right one for a capitalist economy.
Well, we're trying to figure out whether the 2.4% GDP is just simple Keynesian economics with the IRA and the CHIPS Act and the Recovery Act and all that. And that's probably a bad lesson right now to feel so good about the soft landing because the economy is holding up so well in the face of all these interest rate hikes. But if it's because of what you just said, because a lot of the GDP is government, deficit spending, propping up all these projects and propping up labor, then sooner or later it just seems like that doesn't work. Sooner or later you say, well, now interest rates are higher and we can't do all the things we want to do because of all the debt service.
Well, yeah. And, some people will say, well, ultimately, the infrastructure investment by the government will pay off with lower inflation because presumably you increase productivity.
Yeah, we keep hearing that.
But you could say the same thing about why not have let the free market determine the cost of capital? Why not lure banks away from lending with these high rates paid by the Fed and let them engage in the investment in a future productive economy But then that has been seen under the Fed's model as inflationary. That's what they try to curtail. It's that multiplier effect that they're trying to undermine, and that's the way they do it. In Paul Volcker's day, the Fed would just be trying to lure banks into a decision between making loans or buying government debt. And so the Fed, through open market operations, could make government debt either more or less attractive by intervening in that market. But now the choice for banks is between letting it sit there doing nothing or buying government debt. And only in third place comes making productive loans to the private sector. So I think that's much worse. At least the government financed debt, you presume it wasn't going down a rat hole. You presume it was doing something useful. I just think the private sector is better at choosing the most useful projects.
Judy, the private sector, Andrew was talking about the Hoover Dam, maybe never happening again. The private sector might not fix LaGuardia. The private sector might not put all the new bridges in or stabilize the bridges or build better airports. How do you do it when you know that the government is the only place that's going to do it? You sort of have to accept that it's not going to be a private sector solution, won't be as efficient as a private sector, but it's something that we have to do, or bridges are going to start.
It's not like the government does it. They hire private contractors, private businesses to construct these things.
Well, there probably are projects, highways, railroads that government could have a role in. On the other hand, I don't think Amtrak is a testimonial to efficiency. And I would say that the worst prospect for me would be to have our commercial banks be part of that government-financed approach.